Finance might seem dominated by billion-dollar stories and trillion-dollar markets, but there's an entire ecosystem thriving at lower, though still significant, deal sizes. Mid-market finance encompasses transactions usually between 10 million and 200 million, and while that might be smaller than the high-profile, eye-popping deals in Silicon Valley or on Wall Street, these mid-sized deals often form the backbone of innovation, job creation, and regional economic growth. Today, we're exploring how companies and investors make strategic decisions in this mid-market zone. We'll cover topics like raising $100 million for expansion, using mezzanine financing to bridge funding gaps, orchestrating $75 million acquisitions, and the specific risk management strategies that mid-tier CFOs employ to succeed in a space full of both opportunity and competition. Let's start by dissecting why mid-market finance is so vital. When people talk about unicorn startups valued at over 1 billion or mega cap corporations worth hundreds of billions, they forget that most real business growth happens at smaller scales first. Companies that generate 20 million to 200 million in annual revenue often create specialized high-value products. These could be industrial components, proprietary software solutions, or niche consumer goods. At this stage, many businesses already have a proven market fit, stable cash flow, and a management team that's ready to expand. Yet, they still need significant capital infusions, often in the tens or hundreds of millions of dollars, to break out of their current revenue band and challenge larger competitors. One of the most important steps in a mid-market company's journey is deciding when and how to raise outside capital. A growing enterprise might opt for a $50 million Series B or C round if it's a startup, or a private equity infusion if it's a more established firm that's looking to expand product lines or enter new geographies. The structures of these rounds can be intricate. While early-stage startups typically deal in convertible notes or safes, mid-market companies often rely on equity deals with more specific investor protections. For instance, a $100 million growth equity deal might involve board seats for investors, certain veto rights over major corporate actions, or liquidation preferences that guarantee investors a return if the company is sold. Sometimes, though, the right answer isn't a straightforward equity raise. This is where mezzanine financing enters the picture. Mezzanine financing acts like a hybrid between debt and equity. Companies pay interest, like a loan, but investors might also receive warrants or convertible features that can turn into equity if certain conditions are met. This option is especially attractive when a business wants to avoid heavy equity dilution but still needs more capital than a typical bank loan can provide. Imagine a regional manufacturing company generating $75 million in revenue, eyeing a new factory that would cost $40 million. Traditional lenders might consider that too risky if the firm already has debt, but a mezzanine fund willing to take on more risk might provide a $25 million mezz loan with an interest rate higher than standard bank loans, plus an option to convert part of it into equity if the factory's expansion dramatically boosts revenue. Another key consideration in mid-market finance is the cost of capital. While mega corporations can often issue bonds at very low interest rates or attract top-tier equity investors at eye-catching valuations, mid-market firms don't always have that luxury. Their brand might not be as recognized, their liquidity may be tighter, and the perceived risk can be higher. All these factors can increase the weighted average cost of capital, WACC. A CFO in a $100 million enterprise typically fights for every fraction of a percentage point in interest rates because saving even 1% on a $50 million loan can translate into an extra $500,000 in annual cash flow, money that can go toward hiring new staff, R&D, or marketing. That's why mid-market executives often pay close attention to credit ratings, collateral, and financial covenants. They also build relationships with niche lenders and private funds that specialize in mid-market deals. Rather than relying solely on large global banks, mergers and acquisitions also play a huge role in the mid-market. Deals valued at $20 million, $50 million, or $100 million can be transformative for smaller businesses, turning them into regional powerhouses or fueling a leap into new verticals. Often, these deals happen because of synergy in distribution networks, complementary tech capabilities, or simple geographic expansion. For example, a $80 million manufacturer in the Midwest might buy a $40 million competitor on the East Coast to gain immediate access to new clients and distribution. The combination of the two could push their total revenue to $120 million, making them more attractive to bigger industry players, or setting them on a path to do further acquisitions. Valuation techniques for these mid-market M&A deals can mirror larger transactions, but with a few twists. Buyers might still look at comparable company analysis, and discounted cash flow, but they often rely heavily on the EBITDA multiple method. If a company's annual EBITDA is $10 million, it might sell for a multiple of anywhere from 5x to 10x, depending on the industry growth rate, competitiveness, and potential synergies. Sometimes intangible factors like founder reputation, brand value in a niche community, or specialized intellectual property can push the multiple higher. Post-acquisition integration is typically more hands-on in mid-market deals, because synergy often hinges on uniting smaller teams and blending technology stacks that might not be as standardized as in large corporations. There's also a significant private equity PE presence in this mid-market space. Large billion-dollar PE firms certainly look for big fish, but many mid-sized PE shops specifically target deals in the $20 million to $200 million range. They might execute a buy and build strategy, rolling up several smaller companies in a fragmented industry to create a combined entity that cracks the $200 million or $300 million revenue mark. Once they've increased efficiency, improved governance, and boosted profitability, they might sell that newly scaled business to a strategic buyer or another PE firm. The timeline for these deals often spans 3 to 7 years, with a focus on driving operational improvements like upgrading ERP systems, streamlining supply chains, or cross-selling between merged companies. The capital structures can be intricate, blending senior bank loans, mezzanine debt, and equity checks from the PE sponsor to pay for the acquisitions and expansions. Another angle often neglected in mid-market discussions is risk management. While big corporations have entire departments dedicated to hedging interest rate or currency exposures, mid-sized companies must handle these risks with more limited resources. For example, a $100 million apparel exporter might do 80% of its sales in the US, but manufacture goods in Vietnam or Mexico, exposing it to foreign exchange fluctuations. A large portion of that risk can be hedged using forward contracts or currency options, but many mid-market companies either don't have the expertise or consider it too expensive. That's changing as more CFOs become aware that a single adverse currency swing, say a 5-10% drop in the US dollar relative to the Vietnamese dong, could wipe out half their profit margin for the quarter. So even smaller finance teams are increasingly adopting basic hedging programs to stabilize cash flows and protect earnings. On top of that, cybersecurity is becoming a crucial financial consideration. While data breaches at Fortune 500 firms grab headlines, mid-sized businesses are equally susceptible, arguably more so because they may not have robust IT defenses. A single ransomware attack can disrupt operations for weeks, costing millions in lost productivity and brand damage. Insurance is available, but policies can be expensive, and the coverage may not fully compensate for intangible damages. CFOs and COOs must therefore collaborate to invest in cybersecurity, not as a nice to have, but as a direct protection of the bottom line. We're at a stage where a $50 million or $100 million business must consider cybersecurity spending not just as an IT cost, but as a form of operational insurance that could save them from catastrophic financial loss. Let's pivot to an exciting area: expansions and international growth for mid-market enterprises. Picture a technology firm in the enterprise software space generating $40 million in annual revenue. They see an opportunity in Europe or Asia, so they plan to open offices overseas. That expansion might cost $10 million or more over the first year, hiring staff, setting up local servers, meeting regulatory requirements, and another $20 million to scale marketing and local partnerships over the next 2 years. Even though the firm has a strong product and decent domestic traction, it may not be able to self-finance such a rapid expansion. So they might raise a $50 million growth round from a venture capital or growth equity firm, using half for the international rollout and the rest for R&D to tailor their product to international clients. If successful, the company's revenue could double or triple, making that $50 million investment well worth it and setting the stage for an eventual $200 million or $300 million valuation. Corporate governance structures at this size also differ from both smaller startups and larger enterprises. Many mid-market companies might still have a founder CEO or a tight-knit leadership team that's used to making quick decisions without layers of hierarchy. When outside investors come in with a $30 million or their $60 million check, they typically expect more formal processes, monthly board meetings, quarterly performance reviews, established KPI tracking. For the founders and management teams, adjusting to these new governance demands can be challenging. The trade-off is that with more rigorous oversight and professional guidance, the company often becomes more attractive to future investors or acquirers, increasing its valuation multiple when it's time for an exit. Now, let's talk about intangible assets, even at these smaller scales. A mid-sized consumer goods brand might have $70 million annual sales, but commands significant brand loyalty in a niche market like eco-friendly skincare or high-end artisanal foods. That brand loyalty can't be fully captured by typical hard asset accounting. Investors and acquirers might be willing to pay a premium because they see the potential to scale the brand to 200 million in sales with the right distribution deals. This intangible value, often recognized as brand equity or goodwill in an acquisition, might be the difference between a sale at 5x EBITDA and a sale at 8x EBITDA. Similarly, small technology firms might have specialized patents or an especially loyal developer community, which could fetch a premium in an acquisition scenario. So, intangible asset analysis is just as relevant and sometimes even more so in the mid market sector, where brand niches and proprietary tech can create strong competitive moats. One interesting phenomenon is that a number of mid market deals are family owned businesses passing to the next generation or being sold altogether if heirs aren't interested in taking over. In such cases, specialized funds or search entrepreneurs look for stable, profitable businesses in the $10 million to the $100 million revenue range to buy and operate. This strategy is often referred to as an entrepreneurship through acquisition model. The advantage is that these businesses, though smaller, typically have entrenched customer bases, consistent cash flow, and growth potential that was never fully explored by the original owners. With a relatively modest investment, say 20 million to 40 million, an entrepreneur or small private equity group can acquire majority control and implement new strategies that unlock further expansion or operational improvements. If done well, the business might double in value within a few years. Consider also that mid-market finance is not just about raising or deploying capital. It's about creating stable structures for day-to-day financial health, including working capital management. A $60 million company might have $12 million tied up in inventory and another $8 million in accounts receivable. If they can reduce those balances by improving supply chain efficiency or incentivizing faster customer payments, they can free up millions in cash. That freed up cash can then fund new product lines, expansions, or marketing without needing external financing. This is where incremental operational tweaks, from vendor payment terms to dynamic discounting for early invoice payments, can result in big gains for companies that don't have deep pockets. Let's briefly highlight typical CFO priorities in a $100 million company. Cash flow, forecasting, ensuring there's enough cushion for unforeseen expenses or market downturns. CapEx and growth investments, balancing the benefits of new equipment, software, or factory expansions against the need to preserve liquidity. Risk management, determining whether to hedge currency risks, how to handle interest rate exposure on loans, and ensuring critical assets. Investor relations, communicating with private equity sponsors, lenders, or strategic investors about milestones, ROI, and future capital needs. Governance and compliance, establishing committees, financial controls, and reporting structures that satisfy both regulatory requirements and investor expectations. Finally, let's talk about exits or transitions. Mid-market companies might eventually get acquired by a bigger strategic player or a larger PE fund. Alternatively, some go public on smaller stock exchanges, such as NASDAQ for growth stage tech, or specific country exchanges that cater to mid-sized firms. Others remain private but continue scaling until they break into the larger league. The exit valuation for a mid-market enterprise often depends on having a solid track record of revenue growth, profitability, or at least a clear path to profitability. The difference between a company selling at 50 million and one selling at 100 million might hinge on intangible brand value, IP ownership, or synergy opportunities for the buyer. Skillful CFOs and CEOs position their company for such an exit well in advance, sometimes years, by tidying up the balance sheet, improving governance, and building relationships with potential acquirers or underwriters. In summary, advanced finance strategies don't just belong to the realm of multi-billion-dollar corporations or global private equity funds. Mid-market finance might involve slightly smaller numbers, 50 million, 100 million, 200 million, but these deals can be just as transformative for the stakeholders involved. The same principles apply. You still need robust valuation methods, well-considered capital structures, thoughtful risk management, and a keen eye for operational improvements. The difference is that at the mid-market scale, there's often a tighter sense of community and opportunity. Deals can move faster, relationships can be more personalized, and the right approach to financing and governance can elevate a company from a local or regional player to a legitimate national or international competitor. If you're operating in this space, whether as a CFO, an investor, an entrepreneur, or someone climbing the ranks in a mid-sized enterprise, the key takeaway is that advanced finance isn't exclusive to Fortune 500 boardrooms. Mastery of these concepts can propel your organization to new heights, sometimes doubling or tripling valuation in just a few years. By leveraging mezzanine financing, building strong bank relationships, pursuing well-timed acquisitions, and unlocking intangible assets, a $40 million or $80 million business can quickly evolve into a $200 million success story. And in some ways, the path to growth is more accessible in this zone than in the supersaturated billion-dollar markets. The question is whether you're ready to implement the right financial strategies, take calculated risks, and position your company for the opportunities that arise in this dynamic middle ground of global finance. Enjoy this deep dive into mid-market finance. Make sure to subscribe for more content on advanced financial strategies, from launching $50 million expansions to orchestrating $100 million M&A deals. Because while billion-dollar headlines grab attention, it's these 10 to 100 million ventures that often have the most room to innovate, expand, and deliver outsized returns. Now's your chance to harness these insights and help your organization or your investments flourish in the mid-market space.